Welcome to the Dr. Carmenatty channel, where we equip you with the clarity and the conviction to navigate the world's most powerful financial currents. We cut through the noise, we decode the headlines, and we deliver the actionable insight that puts you in command of your future. You do not just watch the markets, you master them. Today, with the help of Google Gemini, we confront the single most critical financial question driving the global economy. Is the artificial intelligence investment boom, the engine of this epic equity rally, a stable foundation or a ticking time bomb poised to explode like the dot-com crash of 2000? For nearly 3 years, the US stock market has delivered explosive, unprecedented returns. The S&P 500 index has surged almost 90% since October 2022. That monumental climb? It rests almost entirely on one colossal singular factor: the surge in capital expenditure, or CapEx, dedicated to building AI infrastructure. We are talking about the massive spending on servers, specialized chips, and data centers by the largest cloud providers, the hyperscalers. This is the financial bedrock holding up the entire bull market. But now, a significant voice on Wall Street, Morgan Stanley, backed by the rigorous analysis of Global Director of Research Katy Huberty, is issuing an urgent, detailed alarm. The bank is signaling that this foundational AI CapEx cycle is not just overheating, it is nearing its climax. It is time to look past the hype, ignore the headlines promising infinite returns, and confront the cold, hard financial reality. We must understand the risk we face because this is not a drill. The seventh inning. Warning: the velocity of risk. Morgan Stanley's Global Investment Committee tells us exactly where we stand. The AI CapEx boom has moved past the easy, explosive growth of the early game. We are not in the first inning. We are much closer to the seventh inning of this capital deployment cycle. What does the seventh inning mean? It means we have reached peak intensity. The easy money has been made. The initial rush to deploy capital is nearing saturation. We transition from a focus on how much companies spend to a demand for how well they spend it. Now, scrutiny, efficiency, and return on investment, ROI, become the dominant forces, forcing a brutal reckoning with valuation. The moment the market demands ROI, the entire financial structure of the AI boom comes under threat. The problem centers on the financial health of the largest AI cloud providers, the hyperscalers. They are engaged in a frenzied, no-limits race to secure computing power, and that intensity is crushing their financial stability. The quantified threat: free cash flow erosion. You need to know this one number, because it dictates the entire risk profile. Free cash flow, or FCF, for these major hyperscalers is projected to shrink by approximately 16% over the next 12 months. That is not a minor adjustment, it is a profound financial contraction. Free cash flow is the single most important metric for any technology investor. It represents the actual cash a business generates after accounting for money spent to maintain or expand its asset base. It is the lifeblood, the ultimate source of a company's financial flexibility, and its ability to fund future growth without reliance on outside capital. When FCF growth slows, or in this case turns decidedly negative, it strips away the primary financial justification for the astronomical valuations these companies command. Investors pay a premium for technology dominance, but only if they see continuous, aggressive FCF expansion. A 16% projected contraction fundamentally challenges the sustainability of this entire valuation model. You must ask, why is this happening? First, the money these hyperscalers deploy to fund generative AI, the cash stream they use for this speculative CapEx, flows from their legacy revenue segments, like core cloud services, search, and digital advertising. Guess what? Growth in those core segments is slowing due to market saturation and increasing competition. They are supporting a massive, risky new investment with a decelerating, less robust foundation. That is a dangerous combination. Second, the nature of AI capital spending creates tremendous financial inflexibility. Building specialized silicon and enormous new data centers involves multi-year fixed projects. You cannot just turn off a data center construction site on a whim. If FCF, your internal liquidity, contracts sharply, the fixed commitment of that massive CapEx creates an immediate, acute funding deficit. This inflexibility forces these companies to seek external funding, often leading to the most alarming structural risk of all: the pathology of the bubble, circular financing. The deepest, most unsettling parallel between today's AI boom and the 1990s dot-com era lies in one specific, insidious practice: circular financing and vendor deals. Morgan Stanley warns us, recent deal-making in generative AI smacks of speculation on unprofitable technologies and schemes. This situation reflects the financial pathology that underpinned the collapse of the telecom and internet bubbles in the 90s, in which suppliers essentially funded their customers to manufacture demand. Imagine this scenario. A major cloud infrastructure supplier commits to building a massive amount of compute capacity for a generative AI business, a business with an unproven fledgling revenue model. Then, the supplier finances that commitment with debt. In another instance, the dominant US chip maker, whose success relies on its largest peers, is reportedly providing vendor financing directly to large language model developers. What does this practice do? It artificially inflates demand signals. The revenue the supplier reports is not supported by organic, profitable market pull. It is supported by financial engineering and speculative debt. This distortion of demand encourages hyperscalers to continue their aggressive, expensive CapEx cycles, based on an illusion rather than verified, long-term ROI. Analyst Todd Castagno at Morgan Stanley has called for radical transparency, demanding clearer disclosure to map which entity is financing whom, and on what terms, because this opaque structure obscures accounting and cash flow quality. If these circular deals fail, if the debt cannot be serviced, or if the music stops, the market correction will be swift and devastating for the specific companies involved. This structural fragility is the most critical similarity to the fatal flaw of the dot-com era. The deferred payoff, the widening time gap. Now let's look at the operational timeline. We call this the diffusion gap. The research analyzed by Katy Huberty and her team clearly shows the timing problem. The vast accelerating cost of capital expenditure, the spending, is happening now. Companies deploy billions today. But when will the revenue that justifies this spending finally arrive? Data compiled from Chief Information Officer, CIO, surveys reveals a critical, risky time mismatch. The revenue from broad enterprise adoption is heavily backloaded. The majority of CIOs do not expect their initial AI and large language model projects to move into full production until the second half of 2024 and throughout fiscal year 2025. Think about that time gap. Investors pay today's inflated prices in the hope of imminent exponential returns. But the reality is a 12 to 18-month delay between the peak intensity of the cost, FCF shrinking 16%, and the expected commercial payoff, revenue starting in 2H24 FY25. This chasm is where short-term financial risk concentrates. If enterprise adoption proves slower, more complex, or simply less transformative than these valuations demand, the infrastructure stocks face a highly vulnerable correction before the fundamental AI revenues arrive. You must respect the power of this timeline. The dot-com baseline, a comparative strength. Now we zoom out for a crucial structural comparison to the dot-com bubble of 1995 to 2002. Understanding the difference is your edge. The dot-com crash was a systemic failure. The Nasdaq Composite Index plummeted by a staggering 77% from its March 2000 peak to its October 2002 low. Thousands of speculative, zero-revenue startups fueled that collapse, with no viable business model. They relied entirely on venture capital and investor euphoria. Companies like Pets.com and Webvan vanished. That was dispersion risk, widespread failure across the entire industry. Today's environment is fundamentally different. Thousands of cash-burning startups do not drive this AI surge. A concentrated group of profitable, dominant companies, the Magnificent Seven, established it. They possess robust underlying revenue streams that routinely meet or beat expectations. While their AI growth is still nascent, their core businesses, search, advertising, and established cloud services, provide a stable, powerful financial foundation that prevents a total systemic collapse like 2000. Therefore, we are not looking at a systemic zero fundamentals bubble. We face a concentrated sectoral valuation bubble. The risk is not dispersion, it is concentration risk. Any severe valuation compression in these highly weighted AI infrastructure components will disproportionately impact the entire equity index, causing a substantial, swift loss. The threat is not bankruptcy, the danger is a brutal repricing. The primary enemy is not a lack of fundamentals, it is the opacity of the funding. the velocity of the capex, and the gap between cost and realized revenue. The blueprint for action, mastering the transition. You do not retreat from the market. You adapt to the reality of the seventh inning. Your action plan must focus on capital quality and operational transparency. This is how you seize control. Action 1. Demand radical transparency. You must pressure the companies you invest in, the hyperscalers and the infrastructure suppliers, to provide granular disclosure. Do not accept vague projections. Demand to know the specifics of their financing arrangements, their vendor debt exposure, and their revenue-sharing deals. Separate genuine, organic market pull from financially engineered demand. Transparency eliminates hidden risks. Action 2. Prioritize ROI and financial discipline. Shift your focus strictly to companies that demonstrate a clear, rapid return on investment from their AI capex. Favor the companies that can sustain their massive investment requirements through internally generated free cash flow that is not reliant on decelerating core revenues or opaque external debt. Discipline always beats speculation. Action 3. Position for the deferred payoff. Understand the diffusion gap. Commercial revenues are expected in 2H24 and FY25. This fact tells you something powerful. If a sharp correction occurs, triggered by FCF stress or a collapse of vendor financing, that correction represents your ultimate buying opportunity. Keep capital liquid, position your portfolio with discipline, and be ready to deploy selectively when high-quality assets are available at lower, more rational multiples. You acquire the asset just before the expected phase of true commercial payoff begins. We stand at a pivotal high-stakes inflection point. The AI boom is foundational, but the investment cycle fueling it is showing dangerous signs of speculative excess and financial fragility. Master the data, understand the timeline, and command your emotional state. This allows you to convert market turbulence into financial power. Thank you for tuning into the Dr. Carmenatty channel. If this analysis gave you the clarity you need to master this market, share your thoughts in the comments below, hit the like button, and subscribe so you never miss the critical insight that puts you ahead of the curve.